I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is March 23rd.
And this is your interest rate update, along with some very important, critical Fed movement information on, where the Fed funds rate's going.
That's right. And remember, this is for informational purposes only. This is not financial advice. And if you like what we're doing here, we come out with these updates. Be sure to subscribe, comment, like. And if you have any questions on mortgage loan scenarios at all, be sure to just send us a comment. We do reply as soon as we can. And big news yesterday came out. Jerome Powell spoke. The Fed rate did increase by 0.25%, and it was expected that they would raise it 0.25%, but it wasn't expected. That was kind of a recent development. About a week ago, that sentiment changed. Once the banks started failing.
And actually, before the banks started failing, it changed. Remember, it went from 0.25 to potentially 0.5. And then all of a sudden, the banks had a little bit of a hiccup, a big hiccup.
That's
and
right.
They're like, whoa, what are we going to do? Are we going to go 0.25? Or are we going to go to zero? All of a sudden, no one talked about 50.
Yeah, so that's, I guess, what I was trying to say is that before the banks failed, we were almost certain that we would have a 0.5% hike in the rates.
Yeah.
But because of the bank failures, there were 4 banks out there that were really in trouble. So what happened was, I think that really scared the markets. It scared the Fed. At least they knew that they were doing their job by really hindering the growth.
Yeah.
And so it came in at 0.25. So it really wasn't a surprise. But again, things have been moving very rapidly.
Very, very volatile.
Yeah.
It has been quite a week.
So right now, if you just want to, the Fed rate, sometimes it's hard for people to say, what's the Fed rate today? And a lot of people would have to Google it. But today, the Fed rate is 5%. Now, they usually bracket it like 4.75 to 5%. But for some reason, it's in between that quarter, 4.75 and 5%.
But we're just going to make it easy. We're just going to call it 5.
It's 5%.
Let's
okay,
call it
that's
5,
the Fed.
folks.
Yeah, Fed rate today 5%. I think it would be good to go over. Basically, when the Fed met and Jerome Powell spoke, there were really important things. And the reason why we're even talking about the Fed rate and all these updates is because it does affect mortgage rates. If you're looking for a refinance or a home mortgage for a purchase, and you want to know about rates, all this stuff affects rates, and that's why we're going into it.
Yep.
Okay, so first big thing I think it's important is that Jerome Powell said that the idea was in his previous speeches that there would be ongoing increases in the Fed rate. Well, that's off the table. I think that, the most consensus, most of the people out there forecasting believe that there's one more increase. As far as their aggressiveness, they've tamper that down, and we should see about one more rate increase, maybe another quarter.
And all the English majors out there probably love this stuff, but to the average person, what do you mean? What is if it's not ongoing? Why would there be one more? Ongoing gives that sense that there could be more than one. It could be 2, 3, but literally by not using that word ongoing, the market is thinking that it's one, which is a big deal.
How about Tom right here?
Okay, so basically the next couple points are important because the Feds had hoped that 2023 would be a slower year, and as they're seeing recently, they're like, yes, not only is it going to be slow, but it might even be slower than what they were anticipating, which is what they're hoping for. Again, they need this market to slow down. It's still just moving too fast. Additionally, an important note is that this banking sector, if it were, market-wide or sector-wide, that'd be a big deal. But they are, isolating it to just a few banks, which is good. It means that it's not systemic.
One of the reporters asked Jerome Powell, do all the banks have this potential problem? And he was just telling them, no, it's really limited to a few banks. And we really hope it is. We don't know for certain, but.
Yeah. And it's like, well, don't banks do what all banks do? Well, yes, in one sense, but in another sense, there are they tailor and cater to different segments of the market. So depending upon what, market you're catering to, you could have more exposure. Than not.
And there could be a domino effect, from one bank. If it's a big enough bank that it really has its loans and exposure to other banks and industries, it can have a real big domino effect. But right now, he says that few banks are.
Yeah, which is good news. Things could change, but that's where we are now.
Yeah, and then Janet Yellen, she's the Treasury Secretary. She did mention yesterday, which really kind of moved the markets. She basically said, the FDIC insurance, it's an old number. That insurance is set at $250,000. And people were asking, is that going to be, there was this implied idea that people would be insured above and beyond that. Well, she basically said that would take an act of Congress to do. So
and we usually use that, in a joking sense, but that's literal.
Yeah.
It would take an act of Congress in order to do that, which tells me that it is possible. Otherwise, because she's not a joker, she would have just said it's not possible.
Yeah.
So that option is out there.
So people with large amounts of money in these banks, can you imagine how they are, how they feel having, I don't mean like, well, what if you did have 100 million in one of these banks? That would be crazy exposure. Well, what if you had $1 million? Mm-hmm. What if you had 2 million? And all these things. And the point is that did really scare the market. So we'll see how that goes with the FDIC. We wanted to show you this chart going back to the 1970s. This is the Fed funds rate, just seeing perspective of where the Fed funds rate has been in the past. Again, the Fed funds rate was almost like, it was around 19% and around 82. But today is it's about 5%. You can just see how vertical it's gone since last year. I wanted to show you guys that. And we've shown this chart many times before. This is the probabilities chart from the CME group. Basically, the futures traders and option traders, what they're looking at.
And literally, when you say future traders, look at it. The top row is May, which is a couple months out. And then it goes all the way until, help me, what is that, a year and a half out?
Yeah.
A year and a half out. So they are literally trying to price out what is going to happen a year and a half out. That's remarkable.
Yeah. So that very left column, the date. So that May 3rd is the next meeting. There won't be any Fed meeting in April. Next Fed meeting is May 3rd. And now I put this tag here for today. This is where rates are today. They're in this column. The rate is we said 5%, but this is the bracket they're in. There's a 38% chance, according to the traders, that rates will stay unchanged in that meeting. There's a 61% chance that the rates would go up a quarter.
Which makes sense. If you go back a couple of slides to where we said maybe one more rate increase.
Yep, so maybe one more in May, but the rest of these traders are, they're saying that you can see these bets, the chances are showing that rates starting in, what is that? It's really July. July, where that weight really moves to a downward movement in the Fed rate. Well, again, this chart, we've been monitoring this probability chart for a while, and it does change pretty quick.
Yeah, and it's awesome chart. Yeah. Awesome.
10-year yield. If you're watching interest rates, the 10-year yield is what's really the best indicator because it moves first. This trades every second of a trading day in Wall Street, whereas the 30-year fixed mortgage does not. So the 30-year fix is just always looking at the 10-year and saying, okay, how do we reprice? Banks are just repricing based off the 10-year.
Yeah, think of the 10-year as like the bigger brother.
Yeah.
That's the thing that everyone kind of looks to and gauges from.
So March 2nd is what we see. We saw a high for this year, and rates were looking real high, and it came down. The 10-year yield has come down 15%, so big improvement in rates. And we're going to go right into,
speaking of rates,
interest rates today. The 30-year fixed, last week we saw that 30-year fixed was at 6.5%. Today we see them at 6.375 for that 30-year. The 15-year we see at 5.625.
The 30-year FHA 5.875. The 30-year VA 5.875.
Those interest rates are based off of these loan assumptions for conventional FHA and VA loans, and they come with no points, no extra fees. A borrower called yesterday who said, well, I can get a rate that was lower, but it came with a bunch of points. Yeah, it came with a bunch of points. We wanted to make sure to clarify that is not, as mortgage brokers, what we want to do is we're showing you these rates. We have very, very low rates, low costs. And so be sure to, be looking at the rate versus the costs.
Good.
And if you like what we're doing, be sure to subscribe and be sure to comment any loan scenarios. We'll be happy to answer those questions.
All right. Hey, thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.